Think for a second about staring at a page of grammar rules for a language you're just starting to learn.
Oh, yeah. That is a terrible feeling.
Right, you're looking at the conjugation tables, the weird exceptions, like the completely unfamiliar alphabet. It is just totally overwhelming.
Absolutely.
Now, take that exact same feeling of anxiety and apply it to opening up a Wall Street earnings report. You just see a wall of acronyms. EPS, PE, Sharp.
Yeah, the panic is identical.
It really is. And it's identical because both systems of communication were fundamentally built by insiders, to keep outsiders out.
Right. The jargon is highly precise for the people who use it every single day.
Exactly. But it acts as a massive wall for everyone else.
It really does create this illusion of an exclusive club. Like if you don't have the password, if you don't speak the language, you're left standing outside.
Assuming the concepts themselves are just too complex for you to understand.
But the thing is, the underlying concepts are actually incredibly grounded in everyday logic.
Which is why today we are tearing down that wall. Welcome to the deep dive. We are going to look at how we can translate the core foundation of Wall Street into plain English.
It's going to be fun.
We are decoding 3 major metrics today: EPS, the PE ratio, and the Sharp ratio.
The big ones.
But we aren't just trying to get you to passively nod along, right? We're looking at the exact phrasing and the mental models you need to confidently explain these ideas to anyone else.
Because by mastering the language, we strip away the intimidation factor.
Exactly. Okay, let's unpack this. Because when you stop seeing a wall of math, you start seeing a story about how a business is actually functioning.
It shifts your entire perspective from a passive observer guessing at what the numbers mean to an active participant who can actually read the health of a company.
So let's get right into the bedrock of that health. When you are trying to decode a business, you have to start with the bottom line.
You really do.
You have to know if the thing is actually making money. And that brings us to the first acronym, EPS.
Earnings per share.
Earnings per share.
Right. It is arguably the most common metric you will hear repeated endlessly on financial news networks, especially during earnings season.
But rather than getting bogged down in the corporate accounting of it all, I love how the source material uses a very simple physical comparison.
The pizza analogy.
Yes. Think of a company's total profit for the year as a single pizza.
Right. So the company operates for 12 months, they sell their products, they pay their employees, they pay the rent, and whatever actual cash is left over at the end.
The net income.
Exactly, the net income. That is the pizza sitting in the middle of the table.
Okay, so who gets to eat it?
Well, around this table sit the people who actually own the company, the shareholders. They put up the money to build the business, so they own that pizza.
But the total size of the pizza doesn't actually tell you how well your specific investment is doing, right?
No, not at all. A massive multinational company might make $10 billion in profit, which, sounds fantastic.
Huge pizza.
Huge pizza. But if they have 10 billion shares circulating out in the world, your individual slice is exactly $1.
Oh, wow. Okay, so EPS is simply representing the exact size of your individual slice.
That's it. It's the total earnings, the pizza, divided by the number of shares, the people at the table.
It measures profitability on a personal level.
Yes, and as an investor, you obviously want to see a higher EPS. It proves that every individual share you hold in your portfolio is generating more money.
It's the direct mathematical link between a giant corporation's overall success and your personal wealth.
Exactly.
Wait, hold on. Let me think about the math of that for a second.
Sure.
Does a bigger slice actually mean the company baked a bigger, better pizza? Or could it just mean there are fewer people eating?
That is the crucial distinction you have to make whenever you look at a ratio.
Because if the pizza stays the exact same size but there are fewer people eating, my slice still gets bigger. Does EPS go up then?
You just nailed it. A ratio always has 2 moving parts, the top number and the bottom number. In this case, the profit is on top and the number of shares is on the bottom. EPS can grow in 2 completely different ways.
Okay, what's the first way?
The first way is the classic ideal scenario. The company sells more goods, margins improve, and they genuinely bake a bigger pizza.
Right. Organic growth, they are just a more profitable business.
Yes. But the second way EPS goes up is through what Wall Street calls a stock buyback.
A buyback. Okay.
Yeah. So if a company has a lot of extra cash sitting around and they don't have like a new factory to build or a new product to launch, they might just go out into the open market, buy their own stock, and retire it.
Meaning they literally shred the shares.
They do.
So they're basically paying people to leave the dining room before the pizza is served.
Effectively, yes. The business didn't necessarily earn a single dollar more in total profit than they did the year before.
The pizza didn't grow at all.
Right. But because there are fewer shares competing for that exact same profit, the EPS, the size of the slice for everyone who decided to stay at the table, gets mathematically larger.
That is wild. I mean, you could have a company whose actual overall profit is totally flat, completely stagnating, but if management aggressively buys back enough stock, the EPS looks like it's growing beautifully on paper.
Which is why you can't just blindly cheer when you see EPS go up. You really have to look at how they did it.
Are they actually building a better business, or are they just consolidating ownership?
Exactly. Both make your slice bigger in the short term, but only one means the company is actually growing its footprint.
That makes so much sense. So if we want to integrate this into how we actually talk about our portfolios, how do we phrase it?
Well, the source gives us a great way to put it into practice.
Let's hear it. Say you're at a dinner party, the topic of investments comes up, and you want to sound like someone who actually understands the mechanics under the hood.
You could drop a sentence like, this company's EPS is growing, which means it's becoming more profitable for every share I own.
Okay, I like that. This company's EPS is growing, which means it's becoming more profitable for every share I own.
That phrasing works incredibly well because it immediately connects the abstract acronym to the tangible result.
Right. You state the observation, the EPS is growing, and then you explain the implication for your wallet.
It grounds the jargon in reality.
Mm-hmm.
You aren't just reciting a ticker symbol, you know.
Yeah.
You're explaining the mechanism of your return.
And I guess that understanding leads perfectly into the next logical hurdle an investor faces.
It really does. Because EPS tells us the company is profitable and our slice is getting bigger. But that profit doesn't exist in a vacuum.
What do you mean?
Well, if a stock costs an absolute fortune to buy, a great EPS might still mean you're making a terrible investment.
Right, because you have to ask, how do we figure out if we're overpaying for that slice in the first place?
Exactly. Value matters just as much as profit.
Which brings us to the PE ratio.
PE, price to earnings.
Price to earnings ratio.
Now that is one of those terms that causes immediate eye glaze for people.
Oh, absolutely. The moment you introduce the concept of a ratio, people assume they need a calculator. But it is fundamentally answering the most basic question in commerce, isn't it?
It is. Is this thing cheap or is it expensive?
Right.
It is the bridge between the price tag the market is demanding today and the earnings we just calculated with our EPS.
And to visualize this, the source moves us away from the pizza and gives us another brilliant analogy. Let's imagine a bubble tea shop in your neighborhood.
Okay, I'm in.
Let's say you get a look at their accounting. After they pay for the boba pearls, the cups, the lease on the building, and the staff, the shop generates exactly $10,000 a year in pure profit.
Okay.
That is their absolute earnings.
Sounds like a solid little business.
Yeah, it's doing all right. So you walk up to the owner and you say, I love this place. I want to buy the whole shop. What's your price?
And the owner looks at you and says, without blinking, $1 million.
Exactly. So you have earnings of $10,000 and a price tag of $1 million.
That massive gap is the PE ratio in action.
Okay, so if you divide the price $1 million by the earnings $10,000, you get a PE ratio of 100.
Right, which means you are paying 100 times the annual profit to acquire the asset.
100 years.
Yes. At the current rate of business, it would take you a century just to earn your initial $1 million back.
See, I wouldn't wait 100 years to break even on bubble tea.
Nobody would.
If I actually agree to hand over $1 million for a shop that only makes 10 grand a year, I am definitely not doing it based on what it earns today.
So why are you doing it?
I must be betting that the owner has figured out a way to open 50 new locations next month, or, that they just signed a deal to put their tea in every grocery store in the country.
Right. So a high PE isn't inherently a bad thing. It just implies massive expectations.
What's fascinating here is that you've just hit on the core psychology of the stock market.
Really?
Yes. The market is a forward-looking mechanism. A sky-high PE ratio is essentially a giant billboard broadcasting the market's expectations.
So they are pricing in a staggering amount of future growth. Exactly. They are paying for the hype, assuming that $10,000 in profit will quickly scale into hundreds of thousands.
They are buying the future, not the present. But wait, what if that future doesn't happen?
That's the risk.
What if it's just a neighborhood bubble tea shop and it's never going to be anything else?
Then you have the alternative reality of a high PE. The The stock is simply overpriced.
Overpriced?
The market has lost its mind. Investors are buying based on momentum and emotion rather than fundamentals. And the company will never realistically grow its profits enough to justify that $1 million price tag.
It's a hype bubble. And if they miss their earnings targets by even a fraction, the whole thing pops.
Because everyone suddenly realizes it's just a $10,000 business.
That's terrifying.
That's the danger. A high PE is demanding perfection from the company.
What about the opposite?
Conversely, you might look at a mature company, like a utility provider.
Okay.
They make consistent money, but they aren't inventing the next iPhone. Their PE ratio might be 12.
Wow, a big difference from 100.
Huge. It's boring, but it's cheap. The PE ratio forces you to ask yourself, do I agree with the expectations the market has set?
So when we see a stock rocketing up in price and the talking heads on TV are screaming about it, we can run it through this filter.
Exactly.
We can look at the PE and say, and this is the template sentence from the source, the PE ratio is quite high, so I think the market is expecting a lot of future growth from this stock.
That is a very calm, rational way to interpret the data. You aren't getting swept up in the emotion of the price going up.
You are diagnosing why it's going up.
Yes, it completely reframes the conversation.
The PE ratio is quite high, so I think the market is expecting a lot of future growth from this stock.
It prompts the real question, can they deliver that growth?
If the answer is yes, maybe it's a buy. If the answer is no, you walk away.
Right. So we've established how to measure the profit with EPS and how to evaluate the price tag of that profit with the PE ratio.
But there is a massive piece of the puzzle still missing.
Oh yeah, the psychological toll of the investment.
Because making money is great, but we have to look at the journey. What kind of anxiety-inducing roller coaster ride did we have to take to get there?
Exactly. We need to look at the danger involved. And that brings us to the invisible half of investing.
Risk.
Risk. Okay, let's talk about the Sharpe ratio.
The source refers to this as the metric for smart investors because amateurs only obsess over returns.
They only look at how much money they made.
Right. But the Sharpe ratio focuses entirely on risk. It forces you to look at how much danger you subjected your capital to in order to get that return.
So the brutally honest question it asks is, are you making money because your strategy is genuinely smart, or are you just taking reckless, huge swings and getting lucky?
Exactly. And to understand the mechanism here, let's look at two hypothetical investors.
Okay, friend A and friend B.
Let's say over the course of 12 months, friend A and friend B both generate exactly $100 in profit.
Okay, so on paper, at the end of the year, their absolute returns are identical. But their journeys were completely different. Friend A took their initial cash, put it into a high-yield government bond or a savings account, and basically went to sleep for a year.
Snooze fest. Zero stress, zero drama, zero chance of waking up to find half their money gone.
A completely smooth, guaranteed ride.
Right. But friend B, on the other hand, took their cash, walked into a casino, and put it all on a single hand of blackjack.
That is stressful.
Yeah, they are sweating, their heart rate is spiking, they are staring at a dealer showing a face card. The dealer eventually busts, and friend B walks away with their $100 profit.
The destination was the same, but friend B's strategy was an absolute nightmare.
Right. So their profits are the same, but the Sharpe ratio is the alarm bell that exposes the blackjack player's reckless strategy.
It perfectly illustrates the concept. It calculates how much excess reward you are getting for every single unit of risk you take on.
But how does it actually calculate that? Like, without getting into a dense textbook formula, what is it actually measuring under the hood?
It does two very specific things. First, it establishes a baseline.
That baseline.
It looks at the risk-free rate, which is usually the return you could get from simply buying ultra-safe U.S. Treasury bonds.
Okay.
It asks, what could you have made by doing absolutely nothing? It takes your total return and subtracts that risk-free rate. Whatever's left over is your actual reward for taking a chance in the market.
Oh, I see. So if the safe bond pays 5% and your risky stock portfolio paid 6%, your real reward for taking all that risk was only 1%.
Precisely. You didn't really make 6%, you just beat the baseline by 1%.
Okay, that's the top half of the equation.
Then it divides that excess reward by the volatility of your investment.
Volatility.
Yes. In finance, volatility is measured by standard deviation. But in plain English, it just means the bumpiness of the ride.
How wildly did the price swing up and down throughout the year?
Exactly. The roller coaster.
So friend A had zero bumpiness. Their volatility was basically zero.
So their Sharpe ratio would be incredibly high because they got a solid return for taking no risk.
And friend B had massive volatility because they risked total ruin on a single hand of cards.
Because the bumpiness denominator is so huge, friend B's Sharpe ratio would be terrible, even though they made the same $100.
It mathematically punishes you for a stressful ride.
It does.
Why does that matter so much, though? Like, if I survived the roller coaster and made the money, why should I care if my Sharpe ratio is low?
Because eventually, the roller coaster breaks you. Volatility is what causes investors to panic.
Oh, human psychology.
Yes. If your portfolio is swinging wildly day to day like friend B's blackjack strategy, eventually you hit a bad downswing, you get terrified, and you sell everything at the absolute bottom out of fear.
Wow, yeah. So a high Sharpe ratio proves you are investing efficiently, not just getting lucky. It means your strategy is smooth enough that you can actually stick with it long term without losing your mind.
Exactly. And this introduces a phrase that is heavily used in professional financial circles: risk-adjusted returns.
Risk-adjusted returns. You aren't just looking at the raw profit. You are adjusting that profit downward in your mind based on the sheer amount of danger it took to achieve it.
It's like evaluating a stunt driver.
Yeah. Did they get the car through the obstacle course quickly because they have incredible control? Or did they just slam on the gas, close their eyes, and miraculously not hit a wall?
You don't want to invest with the driver who closed their eyes, no matter how fast their time was on that specific day.
So, applying this to a real-world conversation, imagine you are sitting across from a financial advisor who is pitching you a flashy, high-growth mutual fund. Instead of just looking at the chart and saying, wow, it went up a lot last year, you can look at the data and drop our final practical phrase.
Let's hear it.
I prefer this fund because it has a better Sharpe ratio, meaning it offers better risk-adjusted returns.
The dynamic of the room changes entirely when you say that.
It really does. I prefer this fund because it has a better Sharpe ratio, meaning it offers better risk-adjusted returns.
You immediately signal that you are a defensive, thoughtful investor. You understand the return is only half the equation, and you refuse to take on unnecessary volatility just to chase a slightly higher number.
It shows you aren't playing blackjack with your savings.
It's the difference between gambling and investing.
We have covered a lot of ground today, pulling apart these dense concepts.
We really have. We went from measuring the actual size of the profit our individual shares generate with EPS.
Right, looking beyond the total size of the pizza to see how much we get to eat, and keeping an eye out for stock buybacks.
To moving from profit to valuation, using the PE ratio and that bubble tea shop to figure out if we are paying for a realistic present or overpaying for a hyped-up future.
And finally, we looked at the safety of our strategy, using the Sharpe ratio to strip away the illusion of lucky returns, focusing instead on the actual risk we are exposing ourselves to.
All while learning the essential English vocabulary to actually discuss them naturally.
Which brings us to a challenge for you, the listener. The source text has a specific output challenge for you.
It's a great one.
Pick one of these 3 terms today. While you are out on a walk, look in the mirror or, just talk to yourself, and try to explain that concept using these analogies.
See if you can explain it simply.
Because if you can explain it simply, you have mastered it. Think about the pizza, think about the bubble tea shop, think about the blackjack table.
See if you can mentally map the high-flying Wall Street rhetoric back to these fundamental concepts.
And that raises a really fascinating question to leave you with. We know that learning these simple English phrases and analogies makes us more confident communicators.
Definitely.
But does the very act of translating complex Wall Street jargon into basic, tangible concepts actually make us more rational, clear-headed investors?
I would argue it absolutely does. Complexity is very often used as a hiding place on Wall Street.
Because it forces us to strip away the intimidating math.
Yes. If an investment product is so complicated that you cannot distill it down to a simple analogy about a business providing a good or service for a profit, there is a very high probability that it is a bad investment.
So the language itself acts as the defense mechanism. If you can't explain the business model to a friend using plain English, maybe you have no business buying the stock.
Exactly. Forcing yourself to explain it simply strips away the math, but it also strips away the smoke and mirrors. True understanding, at the most basic level, is the ultimate risk management tool.
True understanding is the ultimate risk management tool. That is the perfect takeaway. The jargon is just a wall, but it's a wall you can walk right through once you know how the words actually work. Break it down slice by slice. Thank you so much for joining us on this deep dive. Keep asking questions, keep translating the noise, and happy investing.